So you finally got the raise. You know that moment. You're sitting across from your manager, maybe a little nervous, maybe pretending not to be nervous, and they slide that number across the table or say it out loud, and you just feel it. That little rush, that sense of, okay, things are about to change. You drive home and you're already doing the math in your head. You're thinking about what you're going to pay off first, or maybe you're thinking about that apartment you've been eyeing for a while. Or maybe, honestly, maybe you just want to eat at a slightly nicer restaurant without checking your balance first. And that feels like progress. That feels like your hard work finally catching up to your life. And then your first paycheck hits, and you stare at it, and something feels off. The number doesn't look the way you imagined it would. It's smaller, not a little smaller, like noticeably smaller. And you do the math again, slower this time, and you realize you got a $2 an hour raise or a $5,000 salary bump or whatever it was, and somehow your take-home pay barely moved. You're like, wait, where did it go? What happened? That confusion is exactly what I want to talk about today, because I think it's one of the most disorienting and honestly demoralizing financial moments that people go through, and almost nobody explains it properly. My name is Emmy, and I spend way too much time thinking about money, the psychological games it plays on us, and why so many smart, hard-working people feel like they're constantly running on a financial treadmill, moving fast, working hard, but somehow never really getting ahead. And the thing about that raise situation, it's not just about taxes, it's about something deeper, the way we're taught to think about income, compensation, and what making more money actually means. Because I'd argue that most people don't actually understand what they're earning, and that misunderstanding costs them, quietly, year after year. By the end of this, you're going to have a completely different way of reading your paycheck. You're going to understand why getting a raise sometimes feels like a cruel joke, what marginal tax rates actually mean versus what people think they mean, and maybe most importantly, what you can actually do about it, because there are moves you can make. Real, practical moves. But first, we need to understand why the system feels the way it does. Let's start at the very beginning, because I think the root of all this confusion is actually pretty simple. Most people, when they think about their salary or their hourly wage, think about that number as their income, like I make $60,000 a year, or I make $25 an hour, and that number becomes really emotionally significant. It's how we measure ourselves. It's what we tell people at dinner parties. It's the number we negotiate on. It's the number we fantasize about going up. But here's the thing, that number is not what you make. That number is what your employer agrees to compensate you before anyone else takes their share. And a lot of people take their share before your paycheck ever hits your account. There's federal income tax, there's state income tax in most states, there's Social Security tax, which is 6.2% of your wages up to a certain limit, there's Medicare tax, 1.45%, there may be local taxes depending on where you live, there's potentially unemployment insurance, disability insurance, and if you have health insurance through your employer, that comes out. If you contribute to a 401k, that comes out. By the time all of these things are accounted for, the gap between your salary and your actual take-home pay can be enormous. We're sometimes talking 30–40% of your gross income just gone before you see it. And none of this is a secret, technically, but the way we talk about money, the way jobs are advertised, the way raises are communicated, it's all in gross terms. Always, which means there's this persistent structural gap between what people think they earn and what they actually take home. And that gap, it breeds a very specific kind of financial frustration that I think is responsible for a lot of bad decisions people make, because they're making decisions based on a number that doesn't reflect reality. Now let's talk about the raise specifically, because this is where it gets really interesting and honestly a little maddening if you don't understand what's happening. Let's say you're earning $50,000 a year. You work hard, you get recognized, and your employer gives you a $5,000 raise. So now you're at $55,000. In your head, that might feel like $5,000 more per year, which is about $417 a month. You're already mentally spending it. Maybe that's a car payment. Maybe that's a trip. Maybe that's just a little breathing room at the end of the month. But here's what actually happens. That extra $5,000 gets taxed, and not at some flat, simple rate. It gets taxed at your marginal rate, which is the rate that applies to the top portion of your income. In the US, we have what's called a progressive tax system, meaning different portions of your income are taxed at different rates. The first chunk of what you earn is taxed at a lower rate, and as you earn more, higher portions get taxed at higher rates. So that $5,000 raise, that's sitting at the top of your income, which means it's being taxed at your highest applicable rate.
Let me just make that really concrete. If you're in the 22% federal tax bracket, that $5,000 gets hit with 22% federal tax. That's $1,100 gone right there. Then you've got state taxes, let's say around 5% in a moderate state. That's another $250. Social Security takes another $310. Medicare takes another $72. And suddenly, out of that $5,000 raise, you're actually seeing somewhere in the range of $3,200 to $3,400 in actual take-home pay over the course of the year. Which sounds fine, right? That's still money. But here's the real kicker. That works out to roughly $260 per month, not $400, $260. That is a real and significant difference between what you expected and what you got. And if you went out and committed to a new expense based on that expected $400, a new apartment, a car payment, a subscription box you definitely didn't need, you're already stretched before you even started. And here's where I want to pause for a second, because I think the marginal tax rate thing causes more confusion than almost anything else in personal finance. And it's not because people are dumb, it's because the concept is genuinely counterintuitive, and it gets explained badly almost every time. Here's the myth that a lot of people believe. If you get a raise that bumps you into a higher tax bracket, you'll end up taking home less money than before because your whole income suddenly gets taxed at the higher rate. I have heard this from otherwise very intelligent people. I have heard this used as a reason to turn down overtime, to turn down raises, to deliberately cap earnings. And it is completely, totally, 100% false. That's not how it works. That has never been how it works. But the myth persists because nobody explains it clearly. Here's how it actually works. Imagine tax brackets like buckets. The first bucket, let's call it the 10% bucket, holds the first $11,000 or so of your taxable income. Every dollar in that bucket gets taxed at 10%. The next bucket, maybe the 12% bucket, holds the next chunk of income. Dollars that fall into that bucket get taxed at 12%, and so on up the ladder. When you get a raise that pushes you into a higher bracket, what that means is that some of your new income has spilled over into the next bucket up. Only the dollars in that higher bucket get taxed at the higher rate. All the dollars in the lower buckets still get taxed at their original lower rates. So your raise will never cause you to take home less money than you were making before. Every additional dollar you earned will always result in more take-home pay. It's just that the more you earn, the higher the rate on those additional dollars. That's all it is. But even understanding that, even knowing your raise doesn't vanish entirely, it can still feel like a disappointment because the tax bite on that additional income is real. And more than that, there's something almost psychologically insulting about it. You worked harder, you earned more trust, you proved your value, and the reward feels disproportionately small in your bank account. That's a legitimately frustrating feeling, and I want to take it seriously rather than just say, well, that's taxes, deal with it. Let's talk about something that I think gets criminally overlooked in this conversation, which is the idea of lifestyle inflation, because taxes are only part of why a raise doesn't feel like a raise. The other part is us, genuinely, honestly, us. There's this deeply human thing that happens when we start making more money. Our spending expands to meet our income. It's almost gravitational. You get a raise, so you upgrade your apartment, or you finally buy that car, or you start eating out more, or buying nicer clothes, or taking better vacations. None of these things are individually crazy. In isolation, each one is a perfectly reasonable choice. But collectively, they consume the raise before you ever had a chance to build with it. Economists actually have a term for this. It's called lifestyle creep or lifestyle inflation. And the sneaky thing about it is that it doesn't feel like a decision. It feels like just living your life. It feels like enjoying the fruits of your labor, which you absolutely deserve to do. But what it often means in practice is that your financial position, your actual security, your savings rate, your cushion doesn't improve even as your income goes up. There was a study, I'm paraphrasing here, that found that across income levels, people tend to spend a remarkably consistent percentage of their income rather than a consistent dollar amount. Meaning, as people earn more, they spend more in proportion. The higher earner isn't necessarily building more wealth in proportion to the lower earner. They're just playing the same game at a higher dollar level. And this is why you sometimes hear about people making six figures who are still living paycheck to paycheck. It sounds impossible, but it's actually incredibly common. The raise doesn't build wealth on its own. How you treat the raise is what determines whether it changes anything. Okay, so let me shift now, because I don't want this to just be a bummer. I think there are genuinely practical things you can do, things that real people actually do to make a raise land differently, to make it actually feel like progress. And some of these are maybe more obvious than others, but I want to walk through them with some nuance rather than just throwing buzzwords at you. The first one, and this is the big one, is pre-tax contributions. I know. Bear with me because this genuinely changes the math in a meaningful way. When you contribute money to a traditional 401k or a traditional IRA or a health savings account or a dependent care FSA, those contributions reduce your taxable income, which means not only are you saving money, you're simultaneously shrinking the amount of income the government gets to tax. It's one of the very few legal ways to actually reduce your tax bill, and it's designed into the system specifically to encourage this behavior. So when you get a raise, one of the most powerful things you can do is increase your retirement contributions rather than letting that entire raise flow through to your paycheck. You'll see less of it immediately, yes, but your tax bill shrinks, your future self gets richer, and your present self doesn't have the opportunity to lifestyle creep the extra money away on things you won't remember buying. This is something I think about a lot, the difference between money you have access to and money you don't have. Because access to money is dangerous if you don't have a specific plan for it. When the raise hits your checking account and you can see it, it becomes available to spend. When it's routed into a 401k before it ever touches your paycheck, it just doesn't exist as a temptation. It's doing its thing quietly in the background, growing, compounding, becoming something real over time. And the tax savings in the present are just a bonus.
The second thing I want to talk about is understanding your effective tax rate versus your marginal tax rate, because this is a distinction that makes a real difference in how you see your financial picture. Your marginal tax rate is the rate on your last dollar of income. If you're in the 22% federal bracket, that's your marginal rate. It's what applies to the top chunk of what you earn. Your effective rate is the actual percentage of your total income that goes to federal taxes after everything is applied across all the brackets. And your effective rate is almost always significantly lower than your marginal rate. Someone who's technically in the 22% bracket might have an effective federal tax rate of something like 12 or 14% when you account for the lower rates on their lower income and any deductions they take. Why does this matter? Because when people say, I'm in the 22% bracket, they often unconsciously start thinking of themselves as someone who loses 22 cents on every dollar, which isn't true, and that distorted sense of your own tax burden can make you feel more financially squeezed than you actually are, and it can also make you make weaker decisions about things like where to hold investments, whether to do Roth versus traditional contributions, and so on. Knowing your effective rate, your real rate, gives you a more accurate picture of your finances, and you can calculate it pretty easily. Take the total federal income tax you paid last year, divide it by your total gross income, multiply by 100, and there's your effective federal rate. Do the same for state. Add them together. That's roughly the percentage of your overall income going to income taxes. It's almost always a more manageable number than people expect. Third thing, and this is one people sleep on, is the power of above-the-line deductions and understanding what you're actually entitled to deduct. A lot of people know vaguely about tax deductions, but they treat it as something complicated and scary that only matters for rich people or business owners. But there are deductions available to regular salaried employees that a surprising number of people don't take. Student loan interest, for example, up to $2,500 is deductible for many people. Contributions to a health savings account if you have a high deductible health plan. Self-employment expenses if you have any side income. Educator expenses if you're a teacher. And then there's the biggie for a lot of people, the decision between the standard deduction and itemizing. Most people take the standard deduction because it's simpler, and for many people it is actually the right choice. But some people would benefit from itemizing, particularly homeowners who pay a lot of mortgage interest, or people with high state and local taxes, and they just never run the numbers. I'm not saying you need to become a tax expert, but spending 1 hour a year actually understanding what deductions you qualify for, or paying a reasonable fee to an accountant who does, that can literally save you hundreds of dollars. Hundreds of real, actual dollars that stay in your pocket. That's not nothing. Fourth thing I want to touch on, because I think it's underrated in this conversation, is the idea of negotiating your total compensation rather than just your salary. Here's a frame shift that I think is really valuable. When we talk about getting a raise, we usually mean a salary increase, but salary is just one component of what your employer gives you. Benefits have real monetary value, and some benefits are specifically designed to reduce your tax liability, which makes them worth even more than their face value. For example, employer contributions to a 401k are essentially tax-free money. If your employer matches your retirement contributions and you're not contributing enough to get the full match, you are leaving free money on the table. That is not a cliche, that is just a fact. It's part of your compensation that you've already earned and you're choosing not to take it. Similarly, access to an HSA or a dependent care FSA or commuter benefits, these reduce your taxable income. $1 in commuter benefits isn't the same as $1 in salary because the commuter benefit dollar never gets taxed, so effectively it's worth more. When you're in a negotiation conversation, or even just evaluating a job offer, thinking about total compensation rather than just base salary can dramatically change the math. A job that pays $5,000 less but contributes generously to your health insurance and retirement match might leave you better off financially than the higher salary one. These are real calculations, and they're worth doing. Third thing, and this is one people sleep on, is the power of above-the-line deductions and understanding what you're actually entitled to deduct. A lot of people know vaguely about tax deductions, but they treat it as something complicated and scary that only matters for rich people or business owners. But there are deductions available to regular salaried employees that a surprising number of people don't take. Student loan interest, for example, up to $2,500 is deductible for many people. Contributions to a health savings account if you have a high deductible health plan. Self-employment expenses if you have any side income. Educator expenses if you're a teacher. And then there's the biggie for a lot of people, the decision between the standard deduction and itemizing. Most people take the standard deduction because it's simpler, and for many people it is actually the right choice. But some people would benefit from itemizing, particularly homeowners who pay a lot of mortgage interest, or people with high state and local taxes, and they just never run the numbers. I'm not saying you need to become a tax expert, but spending 1 hour a year actually understanding what deductions you qualify for, or paying a reasonable fee to an accountant who does, that can literally save you hundreds of dollars. Hundreds of real, actual dollars that stay in your pocket. That's not nothing. Fourth thing I want to touch on, because I think it's underrated in this conversation, is the idea of negotiating your total compensation rather than just your salary. Here's a frame shift that I think is really valuable. When we talk about getting a raise, we usually mean a salary increase, but salary is just one component of what your employer gives you. Benefits have real monetary value, and some benefits are specifically designed to reduce your tax liability, which makes them worth even more than their face value. For example, employer contributions to a 401k are essentially tax-free money. If your employer matches your retirement contributions and you're not contributing enough to get the full match, you are leaving free money on the table. That is not a cliche, that is just a fact. It's part of your compensation that you've already earned and you're choosing not to take it. Similarly, access to an HSA or a dependent care FSA or commuter benefits, these reduce your taxable income. $1 in commuter benefits isn't the same as $1 in salary because the commuter benefit dollar never gets taxed, so effectively it's worth more. When you're in a negotiation conversation, or even just evaluating a job offer, thinking about total compensation rather than just base salary can dramatically change the math. A job that pays $5,000 less but contributes generously to your health insurance and retirement match might leave you better off financially than the higher salary one. These are real calculations, and they're worth doing. Fifth thing, and this one's a little more philosophical, but I think it's important, is developing what I'd call a slower relationship with income growth. Here's what I mean. We live in a culture that fetishizes income as the primary measure of financial progress. Get a raise, get a promotion, get a higher salary, and you're winning. And income matters, obviously. Earning more creates more options. But the actually wealthy people I've come across and read about and studied, they're often not the ones focused obsessively on growing their income. They're focused on growing the gap between what they earn and what they spend. That gap is what builds wealth. That gap is what creates freedom. A person earning $100,000 and spending $98,000 is significantly less financially secure than a person earning $60,000 and spending $40,000. The higher earner feels rich. The lower earner is building wealth. These are not the same thing, and conflating them is one of the most common financial traps there is. When you get a raise, the instinct is to upgrade your life immediately because that's what you deserve, because you worked for it, because why not enjoy it? And I'm not saying don't enjoy it, I'm saying be intentional about it. Decide, actually consciously decide what percentage of that raise you're going to absorb into lifestyle and what percentage you're going to route into future security. Even if that split is 70-30 in lifestyle's favor, that 30% going towards savings or debt payoff or investing is compounding quietly. It's building something, and 10 years from now, that something will matter enormously. The raise isn't the destination. What you do with it is.
There's one more thing I want to say before we wrap this up, and it's something I think a lot about when it comes to money and work and all of this. We talk about taxes like they're purely a theft or an obstacle, and look, I understand that instinct. It's real money that leaves your hands. But taxes pay for roads you drive on, schools that educated you, emergency services that show up if something goes wrong, research that produced the medications that might one day save your life. I'm not making a political argument here. I'm not saying the system is perfect or that every tax dollar is spent wisely. I'm just saying the framing of taxes as only an enemy is a really limited way to think about it.
And I think it actually makes people feel worse about their finances than they need to. The goal isn't to hate your tax bill. The goal is to understand it, to minimize what you legally can, and to make sure the money you do take home is working as hard for you as you worked for it. That's a healthier and honestly more productive frame. You're not fighting a war against taxes. You're managing your financial system intelligently. Okay, let's bring this home. If you've been sitting here feeling that particular flavor of frustration where you got a raise and it didn't feel like a raise, I hope what you're walking away with is something more useful than just, that's life. Because it doesn't have to just be life. There are real levers here. The first thing is understanding the gap between gross and net, between what you're told you earn and what you actually bring home. Not to feel depressed about it, but to make decisions based on reality rather than a number that doesn't reflect what's actually in your account. The second thing is understanding marginal versus effective tax rates and making sure you're not making financial decisions based on a misunderstanding of how the bracket system works. You never lose money by earning more. That's just not how it works. The third thing is using the tools available to you, pre-tax contributions, HSAs, FSAs, deductions you actually qualify for to shrink your tax bill legally and intentionally. These aren't tricks for rich people. They're designed for you. The fourth thing is thinking about total compensation, not just salary, when you're evaluating your job or negotiating anything. And the fifth thing, maybe the most important, is choosing consciously and deliberately what to do with additional income before lifestyle creep makes that choice for you. Because lifestyle creep will always be there, ready to absorb whatever you give it. The antidote isn't misery or deprivation, it's intention. Here's the thing about money that I keep coming back to. The thing I find myself returning to no matter what angle I approach this from. It rewards clarity more than it rewards hustle. You can work incredibly hard and make a lot of money and still feel broke if you don't understand what's happening to it. But when you understand it, when you actually see the system clearly, including the parts that feel unfair or confusing, you can navigate it. You can make choices that compound over time. You can build something that actually feels like progress. That raise you got? Taxes did take a piece of it. That's real. But what's also real is that you have more power over this than you think, and that's the part I want you to hold on to.